again, these features would include everything from price-driven, price-based features to macroeconomic and whatever that you can get your hands on. And you train this machine learning model using these features to predict the sign of next day's return with a probability. That is corrective AI, because once you have that probability, you can use that to determine how much risk you want to take. Maybe the amount of risk you want to take is zero.
I love this approach, man. It's really great. What are some good non-price inputs or data feeds that provide good results for your machine learning?
Well, I mean, news sentiment is usually the first thing that comes to mind. A lot of people would apply large language models to convert news headline into sentiment. News headline on stocks or news headlines on the economy or anything financially related. So, also you can use it to scan through all the company press releases or quarterly reports, transcripts of earning calls, and so forth. So any or even research reports by analysts, these can all be converted into a numerical score 0 to 1 that indicate the sentiment on a particular stock or anything else, or on the, for example, on the direction of the US dollar index, or on the futures of particular futures, oil futures or corn futures or whatnot. So yeah, I mean that is what is generally called unstructured data. Is what is contained in reports that are written in text.
Very cool. So let's pretend you're just starting over again, but you have all the knowledge you have now. And I sent you 10 strategies and said, Ernest, what are you going to do with these 10 strategies? They're 1.2 sharp, all 10 of them. What would you do from here with your machine learning models?
Well, we would typically apply our conditional portfolio optimization technique. So we would use these daily returns of all these 10 strategies as an input, and then again apply our set of pre-engineered features to learn to find out historically under what kind of regime we should allocate more to strategy 1 versus strategy 2 and so forth, and how much. Now, by regime, people often think of this kind of discrete category. Oh, we are in the bull market. Oh, we are in the bear market. Or we are risk off, risk on. But by regime, I'm thinking really in a high dimensional space. To me, regime is not defined by on and off or this kind of discrete categories. It is a point in a high dimensional space. It might have, this high dimensional space might have 20 axes, may have 50 axes, maybe 100 axes. That how many axes is determined by machine learning. It's determined by training a machine learning model. And a regime is just a point within this high dimensional space. So with that point of view, we don't have a sudden jump from one regime to another. To me, it is a smooth transition. We don't believe that, unless you have a sudden news, such as maybe a nuclear detonation somewhere, or some major default from a major company. Other than those extreme events, typically the regime changes smoothly from one point to another. It is possible that it can make a jump from one point to another in this high dimensional space, but generally speaking, most of the time, it is a smooth transition, continuous path from one point to another. And however, despite this continuous move, we should adapt our portfolio allocation accordingly. It should also evolve smoothly. Now, if there's a discrete jump from one point to another because of a sudden news or event, you can potentially require to update the portfolio drastically. Maybe you should suddenly concentrate your capital on oil stock because of some event, or you might want to suddenly switch all your portfolio allocation to bonds or government bond because of some event. But generally speaking, it will be a very smooth and continuous adaptation of capital allocation from one day to another.
Interesting. And how do you measure success? Are you